Hello, everyone. Welcome to the SSSE Diversified Self-Storage Fund presentation. Very excited to talk to you about this today. It's something that you investors have been asking for the last 4 to 5 years. You wanted to participate alongside us as co-GPs. You wanted to basically become an owner in our business at the business level, not at the property level. Well, here it is. SSSE Diversified Self-Storage Fund I was structured to acquire, develop, lend, wholesale, and co-invest on self-storage properties across the United States. We have a proven track record of an average of 139% internal rate of return across $225 million of deals over the past 8 years. We have a massive pipeline of opportunities ready for capital deployment. These are properties that are under contract, so this isn't a blind fund. And then the best part of all, this is a general partner fund. So you get GP economics. You get to share in the asset management fees, in the acquisition fees, in the development fees. So what does it look like? The offering size, we are targeting 15 million. We're putting a hard cap at 25 million. The preferred return is either 7 or 8%, depending on your share class. Target IRI is between 17 and 22%. This is, again, estimated. We always are very conservative, as you can tell from our previous track record. And then the GP LP split is between 70-30 or 80-20, depending on the share class. And it is a target term of 5 years. Here's a disclaimer. Our syndication attorneys want you to pause this and read through it, please. And then when you're ready, go on to the next slides. Here's the agenda, 15 to 20 minutes. We'll talk about the team, the numbers in the secret sauce, the offering, and why we're a good fit. So here's the team. You got me at the top here. I primarily work on equity raising and debt structuring. Steven, Chief Marketing Officer, he is primarily doing all of our marketing as well as our sales and basically acquisitions, dispositions. Eric Platt, director of our construction side. Most of the time, he's our construction manager, but in some cases, he is also the general contractor. You have Ed Patterson, acquisitions manager. Ed is a star at structuring seller finance structures with very creative structures on loan docs, which we'll get into here in a little bit. Donna, lead underwriter, so she spearheads the underwriting team. They can turn around an entire facility usually in 2 to 3 days. Then you have our counsel. So Byron, syndication counsel. David is our general counsel. And then Patrick is our contract counsel. So why now? Well, few things. The first is the changing economic forces. Self-storage is very resistant to economic volatility. It is a recession-resistant asset. As you can see, during the great financial crisis, 2007 to 2009, we were very frothy in the stock market, kind of like today. And then all of a sudden we saw a large crash because a lack of confidence. S&P 500 dropped 22%. Mortgages, if you were investing in debt, that dropped almost 20%. Multifamily residential dropped about 7%. Now, this is REITs that have high access to credit facilities to kind of bail them out. The average investor did much worse than that. Self-storage, negative 3.8%. So out of all the asset classes, one of the best to fare through the great financial crisis. And we'll talk about some other crises where it did even better. Stock market right now is overvalued and overleveraged. You look at this AI bubble that we're in, you look at the PE ratios of some of these companies in the hundreds. I'm feeling a little, shaky about it. I pulled my money out of the stock market. But the nice thing is interest rates are improving, and that is something that benefits self-storage directly. The second is the changing technological forces. Customers are demanding a more seamless experience, as we saw during the COVID-19 pandemic. Not only that, but investors are demanding that self-storage as an industry catch up with technology. Things like using AI, things like using dynamic pricing, like the airline industries use. So, for example, one of the softwares we use is called Veritech. Veritech does three things. The first is it does dynamic pricing. So it will change prices on a 5 minute interval based on how many people are Googling for self-storage in a given area. It will change the price based on how they see units filling up. Are the 10 by 10s more popular or are the 10 by 20s more popular? Let's jack up the rates. They also do a good, better, best scenario. Let's say you want a 10 by 10 unit, it's $190 online. But then when you get to the site, you see that that $190 is for the third floor on the farthest corner from the elevator. Well, if you want third floor next to the elevator, then it's 210. Or if you want the first floor next to the elevator or next to the office, then maybe it's 230. And last but not least, it also helps us score our customers in order to see who is most likely to absorb a rent increase. It'll rate all our customers from 1 to 10 on factors like, hey, this person is paying every month with an auto debit that comes off their Amex Platinum card. This person's more likely to absorb a rent increases versus someone that pays with cash every month that's late every month by a few days. So we'll score them 1 to 10, and then we'll assign a dollar amount to increase their rents based on that number. Very cool technology that we're using. And then last but not least, we have changing social forces. This is kind of a big one right now. The pandemic had a very interesting effect on the population. There was somewhat of a K-shaped recovery. So those that did not have assets did not do very well. Inflation really eroded their buying power. This caused them to downsize in housing while housing was also skyrocketing at the time. These people are more likely to use self-storage as an external closet, as a permanent fixture, permanent room addition to their house. Then you have the other side where the investors that had hard assets that do well during high inflationary times, the upper leg of the K recovery. Those investors end up accumulating a lot, buying a lot. Something like 50% of the consumer activity in the United States right now is being done by the top 10 to 20% of the population. Because of that mix of the housing prices, you have this massive growth in demand. So prior to the pandemic, 1 in 11 and a half houses were using self-storage. Post-pandemic, 1 in 9 were using self-storage, and that number continues to climb. As you can see, over the last 3 decades, self-storage has outperformed almost every other sector. So this is a study done by the National Association of REITs and Y charts from 1994 to 2021. So the S&P 500 returned about 11% during that time. Residential apartment buildings and housing portfolios, single family home portfolios returned about 14.5%, 14.4%. And then self-storage returned 18.8%. Now that 8% above the S&P 500 may not seem a lot, or that, call it 4.4% above residential may not seem a lot, but you got to realize this is compounding interest. So these numbers turn into astronomical values, and you'll see that on this next slide. So let's say you had $100,000 to invest in 1994. What would the value of that be in 2021? If you put that in the S&P 500, you'd have 1.6 million. If you put it into housing, have about 3.8 million. If you put it into self-storage, you would have 10.4, 10.5 million. Look at the massive over doubling of the return versus residential, or almost 8xing uh, over the S&P 500. So what's the big idea? The fund is designed to deliver consistent risk-adjusted returns through a multi-pronged approach across the self-storage sector. So not only diversification across geographies, but also diversification across strategies within the self-storage industry. The first, which is the most heavily preferenced here, is existing value add facilities. This is going to be 65 to 70% of the portfolio. These are deals that we're buying from mom and pop operators. We're optimizing operations and increasing cash flow. We're going to go improve marketing, and then we're going to modernize the facilities. And then we're going to decrease the expenses through tight management, but then also through things like solar. So actually attacking each expense line item to see if we can get those down. Getting new insurance quotes, making sure that we're contesting the property taxes. Primary result of that is for distributions. The next largest bucket is going to be kind of your expansion and development. So this could be probably 20 to 25% of the fund. Expansion of facilities with already a proven demand. So let's say we buy a mom and pop facility that's 40,000 square feet, that's 96% occupied, and we see that there's wait lists not only at our facility, but at the few competitors in the area. Well, that's clear sign of this pent-up demand in that market. So we're going to add maybe another 30, 40,000 square feet to not only catch that pent-up demand, but then also get this facility to the size that an institutional buyer would like to take it off our hands when we end up sunsetting the fund. This also will include a little bit of new developments in undersupplied markets. This is a very small percentage of what we're going to be doing in the fund. Let's say we have a market that we're able to get land for super cheap. Let's say 7 to 10 acres for $500,000. And then we see that rates are $22 a foot in the market, and there's no competitors in a 3 mile radius. And maybe there's, 3 times the demand versus the current supply. That would be a strong target for us to develop in those markets. These types of deals we usually do with our own money until we're ready to raise capital. So that 2 to 3 years of pre-development, entitlements, permitting process, we do that with Fernando and Steven's money, and then once all the risk has been taken off of the development side and the entitlement side, and now we're ready for construction, then we bring the investors in to make sure you're capturing a very high IRR and high equity multiple. So the primary result of these expansion development deals is equity growth. Now we're going to jump across the screen here to wholesaling because this kind of leads to the next three. So wholesaling is when we get a property under contract, we put earnest money up, we do all the due diligence, and then we find out that it's a good deal, but it's maybe not the best deal. Or it's a good deal, but it doesn't fit one of the criteria they have. Maybe it's the market, maybe it's the population, but we know a lot of other investors that do uh, fit those criteria for that deal. So in the past, and what you've seen with a lot of other operators, probably almost all operators, this wholesaling side, these four options here, usually investors don't get access to these because they're very low on capital and they're not intensive on capital, especially the wholesaling, but the results are astronomical. So I'll show you exactly what I'm talking about. Let's say I get a 35,000 square foot facility under contract and I have 500 or $5,000 earnest money to lock it up for 4 months until I have to close. Underwriting says it's good, but not for us. We send it out to our list of 3,500 buyers. Someone says, "Hey, this fits my underwriting criteria. I'm willing to buy it off you, Fernando and Steven, and I'm willing to pay you a $200,000 fee to let me walk into the contract in your shoes." This transaction usually will take anywhere between 6 to 12 weeks only, and we turn $5,000 into, let's say, 200,000. So these are types of deals that no other sponsor is giving you access to, but we are, because again, this fund, the whole purpose of this fund is to let you partner with us at the business level. So every deal we do will go into this fund. From that, because we have this distribution channel, it opens up these other three avenues. So let's say one of our wholesale buyers says, "Fernando, love the deal. I got a lender that's willing to close at 70% loan to cost. I just need an extra 10%. I need it for 12 months. Are you willing to give me 10% of the capital I need for that 12 months?" We say, "Sure." We want preferred equity. So we're going to be sitting above all your common equity investors. If you have no investor, we're going to be sitting above your uh, equity. And then we're going to charge, a market, you know, a pretty good market rate for that. So we've done preferred equity deals where we have gotten 18 to 24%, and then that has been paid back in 6 to 12 months. Private lending as well. Let's say we have an investor that says, "Hey, I got a bank that loves me, they're ready to close. However, they need more time than what you're giving me, Fernando, based on the contract you're signing. Can you bridge me for 3 months or 6 months until my bank is ready to close?" We say we are willing to do that. We will be first position, senior secured or structurally senior position. We're not going to go above 70% loan to cost, and it has to hit a 1.2 debt service coverage ratio day one. And again, we're charging a lot more than what the banks are going to be charging. This could be 10, 12, 14, 16% for a short-term loan. So again, this is the result of this distributions, the result of preferred equity, a little bit of equity growth, but also distributions as well. And then last but not least, kind of the smallest piece out of this wholesaling funnel that we get are these co-investment partnerships. So let's say we have a great operator that finds a deal that's just maybe too big for them at their current stage in development. And they say, "Fernando, we got a great deal. We just need some help. And we're willing to give away 50% or 70% ownership if you come in and kind of hold our hands through this deal." We've done a lot of these types of deals. So with these types of deals, we come in and we get GP participation. Primary result is equity growth, and it also brings us deals that we did not have in our marketing funnel that are strategic partnerships with seasoned operators that we know, like, and trust, both on the development and the value add side. So who is a good fit? Investors looking for GP economics. Like I said, this fund allows you to participate at the company level. No other sponsor in the self-storage business is doing this right now. Investors looking for a diversified exposure to self-storage, not only in geography, but also in strategy. And then investors looking for heavy cash flow, but also with equity growth, equity multiple, and then bonus depreciation. I know we haven't covered this yet, but this is a big piece of our strategy is making sure that we're maximizing the tax advantage nature of self-storage. So we do a cost segregation study on every one of our facilities. And usually what allows that to do is for every dollar you invest into the fund, you will get 50 to 90 cents back in bonus depreciations to offset your taxes. So let's look at the numbers. This is going to be super high level. I know this stuff bores some people. If you're a good fit, if you like the fund, the idea of the fund, you can go through the in-depth analysis and the documentation that is provided in the InvestNext portal. It'll have all the financials, it'll have all the cost segregation reports, it'll have all of the pro formas, all of the due diligence. So you'll be able to see all of that. So here it is. The minimum amount that we're going to raise to start outlaying capital into the onto the street is $1 million. I know we're probably going to shoot past that very quickly. Our target raise amount is 15 million in equity. However, I know that in the past we've had deals that people wanted to get in, they got closed out too fast, then they didn't have the chance to participate because they didn't act fast enough. So we will have a maximum raise cap at 25 million. We have estimated acquisitions in the amount of 40 to 70 million under contract right now. So this is not a blind fund. Target weighted blended loan to cost is 65% loan to cost. And you'll see kind of how that weighting happens. And then minimum debt service coverage ratio across the fund as a weighting blended average is 1.25%. We have some deals that are much higher than that at the 1.5, 1.65 rate. Debt service coverage ratio, that means for every dollar of debt that I got to pay, the facility produces $1.25 in net operating income. So cash flow heavy. Here's the term. First year is going to be the capital call phase. During that capital call phase, we're going to be acquiring self-storage for the 4 years of the fund, the first 4 years, and then stabilizing and already starting to make distributions and capital returns. We have deals that are ready for cash flow distributions day one. And then, of course, in year five, then we'll start doing the asset divestment, making sure that we're positioning these things for a good buyer, maybe on a portfolio level or even one off, depending on who would be the right fit for the assets that we buy. So, what is the secret sauce? The number one thing I always tell people is off market deal sourcing. You need to have a Ferrari engine of a marketing department to be able to get these types of deals. Because I always tell people the deal of a lifetime comes around about every 6 months if you're getting enough deals into your funnel. We look at 10 deals a week just to show you how much marketing we do. Tax advantage to reduce your annual tax burden. This is huge. I see so many sponsors taking all of the tax advantages for themselves and not giving any to the LPs. We do the opposite. We give the majority of the tax benefits to our investors, and we hardly take any. And then, of course, diversified cash flow, heavy emphasis on the cash flow, and then equity growth mechanisms through that other 20%, 25% of expansion plays and ground up developments. So I talk to a lot of you on a one-to-one basis, especially the ones that were already investing in funds and had a lot of issues. And these have been the four buckets that almost all of your issues have been in. So we decided to solve those issues. Number one, cherry picking. You have sponsors out there that have a fund, but then continue to do single asset syndications that don't go into the fund. And then what people notice is that the single asset syndications or even the deals they do on them their own with no investors they tend to be the better ones, and then the fund kind of gets the single base hit, maybe a couple second base type deal. That doesn't happen with our fund. Our fund includes literally every one of our business activities. Every deal that we do will go into this fund. Number two, No GP sharing, no GP economics. This has been a big thing. I know a lot of guys have been asking me, how do I get on the GP side? How do I get to experience acquisition fees and development fees, asset management fees? Well, the solution is to invest into our GP fund. Number three, no self-operation. I know this has been a huge problem with a lot of my investors that have been investing in fund of funds where they invest with someone and then that person then goes and finds another sponsor and invests their investors' money with that other sponsor. So they're just basically cutting a little bit of a vig, if you will, with basically no control on the end deals themselves. That doesn't happen with us. 90+% of the deals that we do, we source, we operate ourselves, we disposition ourselves. So we have the required control needed for our investors. And then last but not least, no distributions. This has been a big one that I've heard from you guys. That you invest into some project, you invest into some fund, and then you have to wait 4 or 5 years for distributions. Our fund, we decided to structure as a heavy cash flow distributions fund, not 100%, because we do want that equity multiple. But on day one, we have multiple deals right now under contract that are going to be day one cash flows. So let's look at those deals. Number one, we have our extra space portfolio. This is a 200,000 square foot portfolio of three facilities around Midway Airport in Chicago. All three are stabilized at like 96% occupancy. However, there is space for upside. There is warehouse space that can be converted, almost 40,000 square feet, that can be converted to additional storage, parking, or contractor units. There's also a bunch of land for additional portables, or even additional outdoor parking, covered parking. So additional value add potential even from adding more solar panels to these facilities. Number two, innovative storage. Uh, Great deal, 72,000 square feet. Um, about 56,000 square feet is an industrial building that we could turn into self-storage. That building alone was appraised for 1.7 million. It also carries 16,000 square feet of drive-up storage, approved for 60,000 square feet of additional self-storage to come. So there's no time waiting for entitlements or permits. This is ready to go. This is a market with a huge lake. It is high income, and there is literally no competition within the 3 and 4 mile radius. Corner storage and rentals, about 3 million equity needed for this one. It is a 90,000 square foot facility in northern New York State. It's actually a portfolio of facilities, four locations near each other, resulting in about 61,000 square feet of storage buildings and then 28,000 square feet of warehouse space. We have the ability to expand that warehouse space, convert it into self-storage, and then partially dispo one or two of the facilities that may be a little bit smaller so that we can get all of our money back out and basically be playing with the seller's money. And here's where you start to see Ed and Steven shine. 10% down payment, 4 year term with a 1 year unilateral extension, so 5 year term at 5% interest. The next one, another great seller finance deal. Pig Pen Mini Storage. 800,000 in equity needed. It's a 40,000 square foot facility in Rochester, New York. Again, you're going to see a lot of New Yorks here, a lot of Illinois, because those states are great for solar credits, helping with that bonus depreciation and that tax advantage nature of these facilities. This facility is 95% occupied despite having no website and being run on paper. Not only that, but a new multifamily development is being built across the street. And then look at the seller financing. 5% down, 7 year term at 5.5% interest, interest only. And this is the big one here, where I was alluding to, being creative with the loan docs. We have the ability to substitute collateral. So what does that mean? Let's say in 2.5 years, we've doubled the value of this facility. We say, you know what? I think it's time to sell it. We have a good buyer, but we don't want to lose the great loan that we have on it. So this substitution collateral clause allows us to sell this facility and then transfer the debt to a new facility that we're buying. Absolutely fantastic negotiating on the part of Stephen and Ed there. Next one's Cumberland Corners self-storage, about 700,000 equity needed. This one's also in New York, about 29,000. It's an existing self-storage facility with, I can't even believe it, 87% occupancy, despite not having a website. And the Google listing says that they are closed every day, all day, no operation whatsoever. They also have obviously below market rates. So this is a very easy value add that we can probably turn around in 12, 18 months and then sell off. Cheat Lake Storage, very interesting. This is one that we actually already own via a previous single asset syndication. We noticed that this facility has multiple assets to it, multiple profit centers. But what we noticed is that the self storage is constantly full, and we have a wait list for that self storage. So what we're deciding to do is turn the two warehouses that we have that we originally stored boats in into additional self storage. The nice part about this deal is that it has a 10-year life insurance loan on it at 5.37% fixed, and we've only used 3 of that 10 years, so we have 7 years left. Here's one of our ground up development deals. 2.7 million in equity needed. We are building a 51,000 net rentable square foot ground up single story development. This is right outside of Charlotte, where 2,300 new homes are being built, and we are the closest self-storage facility to all of those homes. There's currently 3 times the demand in that market than the supply, and they're building a $700 million casino 5 minutes from our facility. The cranes are literally working 24 hours a day and have been like that for the last 12 months. We have already personally invested, me and Steven, personal cash invested 600,000 into this deal, and we already own the land. This one, permits are in hand, so we can start building immediately. And then last but not least, you're going to see another fantastic seller finance negotiation on this one. Charlie Brown, climatic control, 300 equity needed, very low amount of equity needed because it is a cash flowing facility with the opportunity to automate and increase occupancy in Florida. 15% down, 11-year term. Look at this, 11-year term at 4.5% interest with a 30-year amortization. And then on top of that, the ability to substitute the collateral as long as we buy another asset in the state of Florida. So great negotiating on the part of the acquisitions team here. So this is some photos of what we currently have under contract that's going to be going into the fund day one. So let's kind of close it out. What's the offering? There's two classes. There's a $100,000 class, and then there's a $1 million and above class. So 17 to 22% IRR. This is highly conservative. This is us back testing every deal that we've ever done as if we put into the fund in today's environment, today's leverage, today's interest, etc. Preferred return of 7%, 5 years, target raise of 15 million, max of 25 million. Every dollar you put in will get estimated depreciation of 50 cents to 90 cents. If you're at the 100,000 level, it is a 70-30 split over a 7. If you're at the million or above level, it's an 80-20 split over an 8. So, are we a good fit? Do our core values align? Are you a credit investor? Do you have the ability to act fast? Because this opportunity will close quickly. Next steps. Contact me if you have any additional questions. Log into the InvestNext portal, perform all your due diligence, obviously talk to your advisors, complete the subscription booklet, W-9, review the wire instructions, and then send the accredited verification, and then wire your funds in. Thanks very much, everyone. Hope to talk to you soon.